A AED 5 million portfolio, split 60-30-10 across ready properties, off-plan, and reserves, can deliver 40 to 50% total returns over 5 years. Here's the complete allocation framework for AED 5 million, 10 million, and 20 million budgets. Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market.
I'm Rachel.
And I'm Mark. Today we're covering portfolio construction strategies with insights from Parag Kundawal, founder and CEO of Consultaa. This is episode 57.
All right, Mark, let's dive in. Building a portfolio isn't just about buying a few nice apartments. What's the core philosophy for someone looking at the 2026 market?
It's all about balanced aggression. The data from sources like Property Monitor and DXB Interact suggests a strategy that blends immediate income with future growth. You need a mix of ready properties for cash flow and off-plan for capital appreciation.
And spreading the risk, I assume. Not just putting everything in one tower in the marina.
Exactly. Geographic diversification is key. We're also looking at developer diversification, a mix of Tier 1 and quality mid-tier. But the two non-negotiables, a cash reserve of 10 to 20% for opportunities and a smart leverage approach, aiming for about 2.3 to 2.5 times your initial capital.
Okay, let's make it real. I have AED 5 million. What does my shopping list look like?
This is the classic balanced approach. We're talking a 60-30-10 split. So, AED 3 million, or 60%, goes into ready properties. Think 2 decent apartments in JVC for about 1.5 million each. You're getting immediate cash flow with yields around 7.8%.
Nice. Income from day one. What about the 30%?
That's your growth engine. AED 1.5 million into off-plan projects. We're looking at areas with high growth potential, like Business Bay or the infrastructure-heavy Dubai South. You're targeting 15 to 20% appreciation there. Plus, you get flexible payment plans.
And the final 10%? The AED 500,000?
That's your war chest. It sits in cash. It's for maintenance, protecting against vacancies, or jumping on a great deal that pops up. This structure, according to Savills and Knight Frank analysis, targets a 40 to 50% total return over 5 years.
Okay, portfolio doubled. Let's say I now have AED 10 million. Does the strategy just scale up, or does it change fundamentally?
It evolves. At 10 million, you introduce a luxury component for stability. The framework shifts to a 60-40 split between mid-market and luxury.
So 6 million in the workhorse properties?
Precisely. AED 6 million spread across high-yield areas like JVC, Business Bay, and Dubai South. These are your cash flow machines, generating 6 to 8% yields. The other AED 4 million, your 40%, goes into a luxury asset. Maybe a townhouse in Dubai Hills or a villa on the Palm Jumeirah.
Wait, why luxury? Aren't the yields lower?
Yields might be a bit lower, but it's your portfolio's anchor. CBRE data shows these prime assets have near zero correction risk. So if the mid-market sees a 10 to 15% correction, which is possible, your luxury asset holds its value, protecting your entire portfolio. This balanced approach aims for a 59 to 69% total return.
That downside protection is huge. Okay, final boss level. AED 20 million. What's the playbook?
At 20 million, you can build a truly institutional-grade portfolio. The allocation becomes 50-30-20. 50%, so AED 10 million, forms your luxury core. We're talking an ultra-prime waterfront villa on the Palm, or a property in Emirates Hills.
The crown jewels. What about the other half?
30%, or AED $6 million, is your high-yield engine. JVC, Business Bay, Arion, churning out that 7 to 8% yield. The final 20%, AED $4 million, is for aggressive growth. This is where you target specific infrastructure-linked off-plan projects. Think projects near the expanding Al Maktoum Airport or along the new Metro Blue Line corridor.
And at this level, diversification goes into overdrive. We're talking 6 to 8 properties across maybe 5 to 6 different communities.
Absolutely. And your developer mix also gets more sophisticated. 60% Tier 1, like Emaar and Nakheel, 30% quality mid-tier, and maybe even 10% in boutique or branded residences. The target here is a hefty 62 to 72% total return.
You've mentioned diversification a lot. Let's drill down. Geographically, what's a critical mistake to avoid?
Concentration risk. Don't put all your money in one area, especially one with a huge supply pipeline. Dubai Land Department data shows JVC has over 64,000 units in the pipeline. It's a great area for yield, but you have to cap your exposure there and in places like Business Bay to a maximum of 30% of your portfolio.
So you balance that with
Infrastructure plays. Dubai South is forecasting 15 to 20% appreciation thanks to the airport expansion. And historical data shows areas along new metro lines, like the Blue Line, have seen rental growth north of 23%. That's where you find your alpha.
Okay, what about leverage? You mentioned 2.3x. Sounds risky.
It's about being smart, not reckless. Using mortgages amplifies your returns significantly. UAE central bank guidelines allow residents up to 80% LTV on properties under 5 million, though 50 to 60% is more common. For non-residents, it's about 40 to 50%.
But the key, and we always say this, is the emergency fund, that cash reserve.
It is non-negotiable. That 10 to 20% liquidity is your lifeline. When the market sees a potential 5 to 15% correction, as some analysts predict for the mid-market in Q2, Q3 2026, cash buyers are king. You can pick up assets from motivated sellers at a discount. It prevents you from ever being a forced seller.
Which brings us to 2026. The market is expecting a massive supply dump, right? Around 120,000 units.
Correct. That's the key event to plan around. The strategy is to rebalance before that supply hits. This means you might consider selling some of your mid-market apartments in JVC or Business Bay if your yields start compressing below 6%.
And you reallocate that capital into what? The more resilient assets?
Exactly. You increase your allocation to the luxury segment, which is far more stable, and double down on those infrastructure-linked areas like Dubai South. It's about skating to where the puck is going to be.
And through all this, we haven't even mentioned the biggest advantage.
The zero tax environment. No capital gains, no income tax. A 7% yield in Dubai is a true 7% yield. In London, New York, or Mumbai, that's more like 4% after taxes. That's a 40 to 50% performance advantage baked in from day one.
Okay, that was a masterclass. Let's boil it down. Key takeaways?
First, structure dictates success. Use frameworks like 60, 30, 10 for 5 million, and evolve to include luxury assets for stability as your portfolio grows.
Second, diversification is your shield. Spread across 3 to 5 communities and multiple developers, and cap your exposure to high-supply areas like JVC.
Third, cash is king. A 10 to 20% cash reserve is non-negotiable to protect against volatility and seize opportunities during a market correction.
And finally, plan for 2026. Rebalance your portfolio ahead of the supply peak, shifting from potentially oversupplied mid-market assets to resilient luxury and infrastructure-linked growth areas.
That's your Dubai Daily Briefing on portfolio construction strategies. A structured, diversified, and liquid approach is your best bet for navigating the 2026 market.
If you're planning your Dubai real estate portfolio for 2026, reach out to Parag Kundawal at Consultaa.
Email parag@consultatxb.com. That's CONSULTAADXB.com. Call or WhatsApp at +971 585 964 631 or connect on LinkedIn. Just search Parag Kundawal.
Dubai Daily airs every Monday through Friday at 7 a.m. Dubai time.
Subscribe wherever you get your podcasts, and we'll see you tomorrow with episode 58 on cash flow versus appreciation strategy.
Until then, invest wisely.